Getting paid should be simple, but when you're just starting your business or getting ready to scale, the setup can feel confusing. If you're wondering how to accept payments, especially as a small business owner, you're not alone. This video will explain the essentials every business needs to accept payments, the most popular payment methods, and the associated fees and pricing models. Keep watching to set your business up for success. Before you can accept payments, there are a few core elements every business should have in place. First, you need to ensure your business is registered, whether it's as a sole proprietorship, partnership, LLC, or a corporation. Some payment providers require documentation to verify you're a legitimate business. Then, you'll need a business checking account. This is where your funds will land after a payment is processed, and it should be separate from your personal finances for clarity and tax purposes. A merchant account is an account that allows businesses to accept electronic payments, such as credit and debit card transactions, electronic funds transfers, and ACH payments. It's a temporary holding place for your funds, specifically for payment processing. While you're not required to have a merchant account to get paid, you will need one to take these kinds of payments. When a customer makes a payment to your business, the funds are deposited into the merchant account. After verification and settlement, the money is transferred to your business's bank account. An EIN is a federal tax ID for business entities like LLCs and corporations. You can get one for free from the IRS, and it's often required when opening business bank accounts, merchant accounts, or working with third-party payment processors. Most providers will want to verify that your business has a legitimate point of sale, either a physical location or a professional website where you clearly outline your products, services, pricing, and policies. And finally, you'll need a partner to actually process the transactions. This could be an end-to-end merchant services provider, a software platform with built-in payments, or a custom payment gateway integration. We'll get into the types shortly. There are 4 main ways to accept payments, each designed for different business models and customer preferences. Let's go through them individually so you can figure out which methods are the best fit for how and where you operate. For brick-and-mortar businesses, in-person payments are essential. You'll need a card terminal or POS system that can handle EMV chip cards, tap-to-pay, and contactless payments. The specific POS features to prioritize will vary by industry. For example, hospitality and restaurant businesses benefit from modern terminals that support tipping and customized receipts, while retail stores benefit from features like inventory syncing. According to the Federal Reserve, in-person payments made up over 60% of total general-purpose card payments within the past few years, so it's essential to have a POS system to accept payments if you're selling from a physical location. If you operate an e-commerce store or offer digital services, you'll need an online checkout experience. This typically involves a hosted checkout page, shopping cart plugin, or a custom payment gateway on your website. Ensure your payment gateway provides SSL security and is PCI compliant. With more than 288 million Americans shopping online, offering seamless digital payment options is essential. Businesses with mobile operations like event vendors, home repair services, or mobile groomers often use handheld terminals or mobile payment apps. These tools process payments via Bluetooth, Wi-Fi, or LTE and sync with your main dashboard in real time. Self-service payments are on the rise. Kiosks, QR codes, and unattended vending-style terminals let customers pay on their own, which is ideal for cafes, gyms, parking garages, and gas stations. Before we get into the most popular payment methods, if you're finding this helpful, go ahead and subscribe. We'll keep breaking down the complex parts of payments so you don't have to. Once you've decided how you'll accept payments, the next question is, what forms of payment will you accept? Here's an overview of the most common methods and why you might choose each. Credit and debit cards are still the most widely used payment methods in the US. Accepting major brands like Visa, MasterCard, Amex, and Discover ensures you never turn away a paying customer. Retail, hospitality, B2B, and subscription businesses all rely heavily on card payments for their convenience and speed. Automatic clearinghouse, or ACH transfers, let customers move funds directly from their bank account to yours. This is especially common in B2B settings, recurring billing models, and industries with large invoice amounts. ACH typically comes with lower fees than card payments, but processing times can be slower. Modern contactless options are on the rise and let you accept payments without any extra hardware. Tap to Pay lets customers tap a card or phone directly onto your device. Apple Pay and Google Pay allow customers to pay using their iPhones or Android phones, Apple Watches, and other devices by holding them to the payment device and connecting through NFC technology. QR codes let them scan a unique code with their phone to pay from their mobile wallet or banking app. And payment links are great for sending invoices, quotes, or custom charges over email or text. These tools are gaining popularity, especially among service-based businesses and younger consumers, as 60% of consumers under 40 have used a mobile wallet in the past few years. If you offer memberships, subscriptions, or retainers, recurring billing automates your revenue stream. This setup can be handled through your gateway, CRM, or invoicing tool. For businesses that bill after a service is completed, invoicing lets you send a digital bill that customers can pay online. Look for solutions that support auto reminders and payment status tracking. Buy now, pay later, or BNPL options like Affirm, Klarna, and Afterpay let customers split their purchase into manageable installments. If you sell higher ticket items, this can significantly increase conversion rates. Crypto isn't mainstream for most small businesses, but it is a growing segment. Some gateways allow you to accept Bitcoin or Ethereum and convert it instantly into USD to avoid volatility. Once you're set up to accept payments, it's time to understand what you'll pay per transaction. Let's walk through the three major types of payment processing fees. Interchange fees are paid to the bank that issued your customer's card, also known as the issuing bank. The fees vary by card type and transaction method. For example, keyed-in payments usually cost more than chip or tap transactions because of the higher risk associated. Consider this a baseline cost baked into almost every card transaction to cover the expenses for handling related transaction risks. Assessment fees are charged by the card networks, Visa, MasterCard, etc., and are typically a small percentage of each transaction. These fees cover the expense of running transactions through card networks. They are non-negotiable and apply across the board. Payment processor fees are the markup your processor adds to cover their services, software, and risk management. Depending on the provider, these fees may be flat, variable, or tiered. Choosing a transparent provider can help you avoid hidden fees like batch fees or monthly statement fees. Let's quickly break down the three most common pricing models that payment processors use, so you know what to look for. Also known as Cost Plus, the Interchange Plus model is subject to the interchange and assessment fees, then adds a consistent markup like 0.3% plus 15 cents. It's usually the most transparent and cost-effective pricing option if your business has stable volume. Flat rate pricing bundles all fees into a single rate. For example, 2.9% plus 30 cents. It's predictable and simple, great for startups or businesses with low volume. Tiered pricing groups transactions into buckets like qualified, which generally charges 1.4 to 2%, mid-qualified, which typically charges 2 to 2.8%, and non-qualified, which often charges between 2.8 to 4%. The biggest benefit of this pricing model is its simplicity. There's no one-size-fits-all approach when it comes to accepting payments. The right solution depends on your business model, industry, customer behavior, and long-term goals. By understanding your options and how payment processing works, you can build a system that's cost-efficient, scalable, and ready to support your growth. If you have any questions about accepting payments, leave them in the comments below. If you found this video helpful, feel free to like and subscribe so you can stay ahead of the curve.